Hey everyone, and welcome. So today we're diving headfirst into the world of IPOs, initial public offerings. You see the headlines, you hear all the buzz, but what's really going on behind the stock market's biggest and flashiest debuts? We're going to dig into the data and separate the hype from reality. Let's get into it.
I mean, we've all heard these stories, right? That one person who got in on the ground floor of a massive IPO and just made a fortune. It's the kind of dream that fuels all the excitement, painting these market launches as some kind of golden ticket to wealth.
And this feeling, it creates what I like to call the IPO gold rush. But before we get totally swept up in it, let's take a step back and make sure we all understand what's actually happening when a company decides to go public. At its core, an IPO is really just a company's big public debut. It's that moment when a private firm, which was once only accessible to a handful of insiders and big-shot investors, finally opens its doors and says, "Hey world, you can now buy a piece of our business." It's a massive, massive milestone for them. Okay, but that's kind of where the simple part ends, because the story we're often sold is one of guaranteed, explosive growth from day one. Well, I think it's time for a little reality check, and this one is backed by some pretty serious data. So let's just ask the big question right out of the gate. Is investing in an IPO a surefire path to profit? Is it really the slam dunk that all those stories make it out to be? And, well, here's where the story takes a really sharp turn. When you look at a whole decade of data from One Finance, the picture becomes crystal clear. The median IPO, that's the typical one right in the middle, delivered a return of just under 6%. Now, if you had just put your money in a broad market index like the Nifty 50 or the Nifty 500, you would have more than doubled that return. That's not a small difference, folks. That is a huge performance gap that kind of throws the whole IPO hype story into question. Let's just let that number sink in for a second. 5.9%. For all the media frenzy, all the excitement, the typical IPO has given investors a return that's less than half of what they would have gotten by just buying the whole market. So this brings us to a really important point. If the returns are so much lower on average, why does this gold rush narrative just keep going? What's causing this massive disconnect between what we think happens and what the data actually shows? Well, one of the biggest clues is hidden in why the company is going public to begin with. See, if a big chunk of the IPO is what's called an offer for sale, that just means the original insiders, the founders, the early investors, are selling their own shares. They're cashing out. And as you can see from the numbers, when these insider exits make up more than half the deal, the average return for new public investors just tanks. It's a huge potential warning sign that the so-called smart money might be heading for the door. And it goes way beyond just insider exits. A whole bunch of other things can trip up a brand new public company. Sometimes the initial price is just based on pure hype, setting it up for a big fall. Other times, the company just has bad luck and hits the market right as the economy takes a nosedive. Or maybe, just maybe, under all the shiny marketing, the business itself isn't all that strong. All of these are like potential icebergs waiting for a new stock. Okay, so we've seen the pitfalls. It can look a little bleak, but this doesn't mean you should just avoid IPOs completely. Nope, it just means you need to be smarter and more prepared than the average investor. So let's build your playbook for doing exactly that. Here are 5 absolute must-dos for your IPO checklist. First, you've got to do your own homework. Don't just ride the hype train. Check out who's backing the deal. Are they reputable banks? Be super skeptical of anyone promising you guaranteed returns. And you've got to pay close attention to something called the lockup period, which we'll get into in a bit. But most important of all, you have to read the official rulebook, the prospectus. And this, my friends, is where the real work begins. We need to learn how to actually read these official documents so we can spot both the hidden gems and the giant red flags. Okay. The single most important document you will ever read about an IPO is its red herring prospectus, or RHP. Seriously, think of it as the company's official rulebook. It has everything, the good, the bad, and the ugly, that they are legally required to tell you before you invest a single rupee. Inside that document, one of the very first questions you should ask yourself is, where is all this money going? As you can see here, there's a world of difference between a company raising money for growth, like R&D or new markets, versus one that's just paying off old debts or cashing out its private investors. One is an investment in the future, the other is basically a cleanup of the past. Also buried inside that prospectus, you're going to find the company's valuation. That's the math they use to decide what the initial stock price should be.
And understanding this is absolutely critical to figuring out if you're getting a fair deal or if you're just buying into the hype. Now, you don't need a PhD in finance here, but it really helps to know the two main ways companies justify their price tag. The first is called discounted cash flow, which is kind of like trying to predict the future with a crystal ball. It's all based on estimates of how much profit they think they'll make down the road. The second method is comparable company analysis. This is more like shopping for a house. You just see what similar houses in the neighborhood have recently sold for. It's based on what the market is already paying for similar businesses.
And it turns out academic research shows the method they choose actually matters. While both have a pretty decent track record for having a positive first day, valuations based on comparing the company to its peers have historically had a slightly higher success rate. It's a small edge, sure, but in investing, an edge is an edge.
But successful investing isn't just about what happens on day one. It's about patience and looking for signals about a company's long-term health. And that brings us to our final section, the long-term bet. Earlier, I mentioned the lockup period and how important it is. Let's really dig into that. This is basically a mandatory waiting period where company insiders are legally forbidden from selling their shares. The whole idea is to create some stability and prevent them from just dumping all their stock on new investors right after the big launch. But the real signal, the really juicy information, comes the day that lockup period ends. Do the insiders, the people who know the company better than anyone else, hold on to their stock for dear life? Or do they all rush for the exits at the first opportunity? What they do can be one of the most powerful signs of their true confidence in the company's future.
And that really brings us to the core lesson of this entire explainer. Getting swept up in the IPO frenzy is a recipe for disappointment. Real, lasting success comes from doing the homework, from actually reading the prospectus, and from focusing on the long-term fundamentals. It's all about being an analyst, not a speculator.
So the next time you see a once-in-a-lifetime IPO plastered all over the headlines, I'm going to leave you with this question to think about. Will you see the hype, or will you see the homework? Thanks for joining me.